Okay.
Welcome to the 10th episode of Investment for Beginners. I'm Manuel Maurício, and with me today is Michael Wiggins de Oliveira. Hi, Michael. How are you?
Hey, Manuel. Thank you for having me. So, my name is Michael from Deep Value Returns, where I have a premium newsletter where we talk about investing, helping you become a better investor. And Manuel, do you want to introduce your newsletter?
Well, you can find all about myself and my work at allingstocks.com. We're in earnings season. This is the second or third week of earnings season, right? So there's a lot to talk about. I would like to start this one by talking about the big conglomerates of the past. They are splitting up. We've got General Electric splitting up. We've got Johnson & Johnson and Toshiba. I know Johnson & Johnson pretty well because my girlfriend works there. I've read something about General Electric, and more or less everyone knows a little bit about General Electric. Toshiba, I don't know it that well, but we can use the case of General Electric to illustrate an interesting shift of paradigm that we're going through at the moment. So these are big conglomerates, and General Electric had a really well-known CEO, which was Jack Welch. He's known for being one of the best, if not the best, CEOs in the United States. And the company grew a lot, and it bought other companies, and it expanded into different verticals. And now they are the current CEO, which is trying to get the company. Well, it had a lot of debt. It's like a dinosaur. It moves slowly and all of that. So is trying to make it a little bit more nimble. He announced that he's going to, or the company announced that it's going to split itself in 3 different companies. So it's aviation. They build the engines for airplanes, energy, renewables, and all of that, and health. And the thing is, what drove these companies to become larger and larger and have different segments were synergies, and they would share costs and expertise across many different units. I read that there was this idea that a lot of executives and engineers together working in several different segments would be much better for a company, because there would be some kind of how do you say it? I like the word, but sharing of knowledge and sharing of ideas, and it would benefit the companies. Another argument for the big conglomerates would also be that whenever one of the verticals, one of the segments is facing a downturn or a business issue, the other ones will probably thrive, and there's less volatility, so the company becomes more resilient. Today, what we're seeing is the exact opposite, because the excuse to split up is that investors who want to invest in healthcare don't want to invest in energy, or don't want to invest in airplane engines. So the company has become so complex and so hard to run, all of these different segments, that it's better to split them up and make them each its own company, focused, more nimble. And shareholders and investors today prefer that, because they can easily, with ETFs, with stocks, etc., they can make their own diversification, and they don't need the company to diversify itself. So it's pretty interesting. This one bear argument, or one argument that Buffett used sometimes, is that investment bankers are all over this. Not exactly this today, but all over this. First of all, they want they want these companies to buy a lot of companies because they earn their fees. And then when they get to become super giant companies, they want them to split up and break apart, because they will earn fees as well. So there's a bear argument to this thesis. I don't know if you've been watching this, but J&J, Johnson & Johnson, is the same thing. They're separating their consumer segment from their pharma and medical devices businesses, because they argue that they're different. They have different consumers, right? So the consumer business is going to mainstream people, like shampoos, creams, all of that. The other ones are marketed to doctors and in hospital sets. So they're arguing that it's a better it will be two better companies than when they're together. Which leads me to something that I now get to know you. I've got to know you a little bit better, and we both, although we have different styles, but we both are more focused. And I think that's the reality for most of investors right now. Are more focused in high growth companies, particularly tech companies, and not so interested in these conglomerates. But what we're seeing today is that, take for example, Amazon or Alphabet, they're becoming the new conglomerates, right? They're buying other companies, they're investing in the moonshots or the other bets like cars or whatever. They're becoming the conglomerates. And I wonder if 20 years from now, we're going to be seeing all of these tech companies of today splitting up and spinning off a lot of their segments. What do you think about this, Michael?
I mean, I have a lot to add here. I was just like, as you're going through, I was trying to kind of remember the points. So the first thing is that people say about Jack Welch that he was an earnings manipulator. I don't have this kind of great view of him. It's just for educational, entertainment purposes. I don't have any opinion on any of these stocks, but it was acquiring those companies. It's kind of like, quote unquote, what Salesforce is doing, or even to a certain extent Shopify is doing, or even Alibaba is doing. They kind of acquire these businesses and they're able to use the accounting to, when it's in their interest, to accrue those earnings over time. So it smooths out. And what do analysts want? Best of all, analysts want growth, analysts want predictability, analysts want stability. And that's exactly what Jack Welch was offering. So I don't remember the figures precisely, but I think that in a year they were acquiring 180 companies. There is absolutely no way that anyone at those 180 companies would have had any kind of ability to cross talk with any other company. So it was just purely a financial mechanism, in my opinion. That's the first thing I wanted to highlight. The ability to cross-sell, I mean, it's impossible. You can't, as you describe yourself, you can't cross-sell an aviation to a healthcare company, okay? That's just like, forget about it.
But for the sake of argument, just maybe inside the aviation they were buying or expanding into other segments.
I don't buy that. I mean, people did buy it, and people did buy it for 20 years. So, and I've always made the case that the market is more often right than analysts, investors in general give reason to it. So, for example, there's plenty of ideas out there, and on average, the crowd is kind of right. And I have seen that in my own experience as an investor. We can stay here and kind of argue about individual companies from our point of view and over-intellectualize each point. But over time, the market is just a phenomenal machine at accurately predicting. And just as a quick deviation, just to back up my story, is that you can say for like the last 10 or at least the last 6-7 years, there's been one Tesla short after Tesla short after Tesla short, and here we are today at the $1 trillion company, and there's everyone on the planet knows Tesla. So you can't say that the market is wrong, and the market is what the market is. So just let's kind of say if something is going for like 20 years, like General Electric was, nothing new that people didn't know about was around, okay? So it's not that you had like 5 years where it kind of was rallying. We're talking about a prolonged period of time. The other thing is that it was this idea coming back from the 60s that the conglomerates would smooth out the earnings. And as you said, that you alluded to very accurately, it's like when one bit is in a downturn, you're able to kind of distribute those earnings from something that is doing slightly better and smooth it out. And, like, as Jack Welch would say in some of those interviews, if you read from back in the day, it's like, what's wrong with that? The investor wants to smooth earnings. The analyst wants to smooth earnings. I want to deliver. What's the problem? One of the things that is quite interesting is that it's not really, in my opinion, at least, in the case with, let's say, Amazon. Let's just use the specific example of Amazon, because Amazon makes it from themselves. It's part of their innovation within their companies that they make AWS and they made a consumer side business. So it's not that they went out and acquired 180 companies, is that they built it from scratch. And they said, okay, this is something that interests us. And we want to we need a lot of this infrastructure. So we're going to build it for ourselves. And then they realize afterwards, other companies may also need it. So we will also sell it to them. And the same within, let's say, within Amazon's consumer business. If you look at, let's say, Amazon Video, it's like, okay, our consumer wants to be on our website to do their research. They kind of start searching doing their research about one product, like what microphone to buy. If they're going to look at the reviews, why not just by chance make them like watch some kind of content, about it. Let's say there's now on Amazon on the reviews, you can see other people uploading videos of how they use a certain microphone, what's good, what's bad. So it's just more engagement. So you get more engagement, and then you spend as well sometimes in the evenings looking at Amazon Video. So it kind of just it's building within the company. It's like one on top of the other. Whereas in the case of General Electric, it was kind of acquiring, and there's no idea that when they're acquiring those 180 companies or whatever, that in a year that they're able to buy at prices that make sense. So what happens is that you end up with a lot of things that that should have no place to be in there, and then they're there.
Let me pause you there, and you're right on that these Amazon and others are building these segments or these new companies inside with their own engineers and without buying them, but they're also buying other companies. So let's say buying other companies, or like Whole Foods or Android for Google, for Alphabet,
and you could say, and
for Facebook.
Exactly. I was going to say about Instagram, about Facebook's acquisition. So it's more nuanced than I kind of just explained. It's not so clear cut. And there is, within each one of those, there's the idea that they kind of, like Facebook has acquired Instagram. So it's not so kind of clean cut. But we're talking about one or two companies like Facebook acquiring Instagram, or Alphabet acquiring Android. So it's like one or so. We're not talking about 180 in a year that is just kind of buy. So it's totally different. It's the idea that I am the owner of this business. I'm the CEO of this business. I'm going to acquire one product that makes sense to my platform. It's not just kind of buying whatever makes sense. But as we discussed, healthcare has very little to do with aviation. Unless you want to do your hair while you're kind of flying a plane. Apart from that.
No, it's true. Even if the growth strategies are different, so you're saying that one was mostly through acquisitions, the other one is mostly through inside organic growth or creation of new verticals. Do you think that someday, 20 years from now, we're going to see, and I'm not talking about being broken up by regulation, I'm talking about breaking up themselves, like we're seeing Johnson & Johnson and GE. Do you believe that they will break themselves? Because, for instance, when you've got Android and search, there are synergies there. I can understand that because you use some data for the other, but AWS and Whole Foods, they got nothing to do with each other, right? So at some point, these guys are going to grow so big that they will have several different segments that don't need to be together.
Absolutely. I think that's very much, and it's good that you said excluding the regulation, because the regulation is kind of something that's right pertinent at this moment in time, but these things go and leave in cycles. So at the moment, regulation is overhanging this, but 5-6 years from now, people might just get bored of this and move on to something else. But in the case of, let's say, for example, of Amazon, they may say, okay, there is no point us spending. The idea of AWS was to get the extra cash flows to reinvest to grow the e-commerce side. And they may say, okay, our e-commerce side is profitable enough that we don't need that extra cash flow. It doesn't make any more sense at this moment in time. We'll spin it off. It is very likely that there's a possibility. It's interesting because in the case of General Electric, it's just that they had so much debt. It's totally different, right? It's a total mismanagement. In the case of let's say these other ones like the Amazon and Facebook, and they're very, very free cash flow generative, very, very strong balance sheets. So it's not the same level. So General Electric was put in a difficult position. So there are plenty of conglomerates out there. So I don't, like, the Financial Times has got an article today or yesterday saying that it's the death of conglomerates. I don't think that it's the death of conglomerates. Conglomerates still make a lot of sense, but these guys, particularly with the case of General Electric, the business got mismanaged. And for a long time, it's just too long. And if you look since, I don't know if it's 2014 or 15, the stock hasn't returned to that high. So it's been like 5 or 6 years in the making. So it's not that all of a sudden people just realize that this is mismanaged. This has been a long term, just kind of going down. I know we're pressed for time, so maybe we talk about the next topic. Yeah, do you want to introduce the next topic?
No, I was just mentioning Johnson & Johnson. They've not been mismanaged, and the CEO of Johnson & Johnson is now actually on the board of Apple because of his healthcare knowledge, and they're just spinning out, they're spinning out the consumer business, which is a worse business than the pharma business. So they're like, I would say, well, shareholders, especially the big guys, right? The big company, big funds, want us to let go of these. How can I call it? It's a worse business right now, right? The consumer business, shampoos and the creams, because you've got all of these smaller, nimbler brands, organic shampoos, and all of that. So it might have been just not because of that or mismanagement, but let's let go of these segments. It's pulling us back, the growth that we see in the other two segments. So that's one. Now, following something that I've told you last week about the 1999 documentary that I've watched, I was just watching some things. Like, we've got Rivian now, which is an EV company, electric vehicles company, which IPO'd, and I think it was the strongest or the highest priced company, or the biggest IPO since Uber. It's now worth, I don't know, north of 100 billion, and it has zero revenue. So this one is kind of interesting. I don't know if you've got anything to comment on that.
So I mean, like, if you think that when you're making an investment, you're making a bet, right? You're saying, I'm making this bet that I can profit more by holding this position over the next 2, 3, 4 years relative to doing something else. So it's a very difficult bet to make, because you're already pricing in flawless execution for numerous years. People always complain, value guys complain about Tesla, but at least Tesla was making cars. I mean, when they were like, it's not the same story here. Like, this is not the same story. They're not even making cars. They're not. I could be wrong here, but from my understanding, they don't even have the plant where they're going to build the cars from ready. So it's not comparable. But everyone wants, Wall Street has one business. Wall Street needs to sell investors that stock. They get paid to talk on it on CNBC. They promoters, stock promoters. So, they kind of need to sell that story. They need to sell, look, we are the next Tesla. That's the story that they need to sell. And they get paid very handsomely to sell convincingly that story. But once they sold that story, they don't care, 6 months down the road, as long as the share price is above the lockup price, they're fine. And, they'll move on to something else.
This is really, really interesting. And it's the illustration of the times we're living, right? And the madness of crowds. Yesterday, someone sent me another video of what's the name of the Nikola, which is another EV company that turned out, I didn't even notice, turned out to be a fraud. So they IPO'd it. They didn't have anything to show, nothing. They had a truck, an electric truck that didn't even drive. So it was just a model of an electric truck. And I'm not saying that Rivian is the same story is the same, but just and GM, General Motors, invested in Nikola. So how come they didn't do any due diligence? That's the hardest part for me to understand. Now even
if you look at Nikola's share price right now, I could be wrong, but I think it's approximately 10 billion. So people, like, I could be wrong on the exact number here, but people know that the company was fraudulent. People, like, it's not new news. This is old news, right? People still know that the company is fraudulent. People know that the CEO was just, he's left now, the founder, but people know that everything pretty much that he said wasn't true. And the valuation is still quite excessive. And it's kind of like, man, like, people talk about like myself, right? People say, oh, the market is mostly right, but you have these kind of pockets where things are totally irrational. Like you got Nikola, you got GameStop right now, you got AMC. It's like you got Hertz as well. Like it's just like it's just mind-boggling. It's a very different. It's very interesting. So it's not like I'm saying to you, it's not a mirror image of the dot-com cycle. It's not really, because there are particular businesses that are expensive, but there's a reason for them to be expensive. But there are certain pockets there that are really just, I mean, it's difficult to justify how someone coming in right now into something like Nikola, that you're going to be able to compound your savings at a reasonable rate. It's very, I mean, it's difficult for me. You wanted to also touch on Zillow quickly?
Yeah, I wanted to touch on Zillow. Zillow has left the iBuying business because it wasn't able to make a profit. It is selling now. It's selling wholesale a lot of houses. I think it was, I don't know if it's already confirmed, but it was to Blackstone or something of sorts. And I know that you followed, and I'm not sure if you're invested in Opendoor. What
I am invested there.
Does Opendoor make a profit from the iBuying? What was the problem with Zillow that Opendoor doesn't have?
Right. So Zillow tried, and they said that we will try to do this business and it to be between 2% plus or minus per profit. So in approximately 2% profit to negative 2%. So we're going to try, and what they found is that their profit margins were negative 17%. So they're like, okay, when things were going up, the house prices were going up. We were trying to play that game. We were not successful. And when house prices calmed down or moderated into Q3, which went past, it went to negative 17%. And they're like, okay, our model doesn't work. They said, customers are not interested enough in this business model, okay? Then Opendoor Technology reported, and Opendoor Technologies are right now on the EBITDA, it was profitable, approximately 1.5% or 1.6%. So they are profitable EBITDA. And if you strip out all the debt and everything, they just kind of at break even. So despite them growing by more than 500% during the quarter, year over year, they're still at break even. And their guidance for next quarter is for them to be up 1,100% year over year. Now, remember that the same period a year ago, their revenues were negative 85%. So when COVID was hit,
revenue was negative.
So revenue, like year over year.
Mm-hmm.
Yeah. So the growth was year over year negative 85%, because when COVID hit, people didn't, those 3-6 months, people didn't want to be buying and selling houses. There's a lot of uncertainty in the US. People didn't know if they were going to keep their jobs. There was a lot of question marks. So people didn't want to be buying a house. But right after that period, when starting Q1, their growth rates are really, really strong. And it shows that sequentially from Q3 right now into Q4, they're going to continue growing at a very aggressive rate. And they're saying that although house prices are moderating, we're able, with our models, to be very, very close to break even. So even though they are competing with Zillow, and Zillow is trying to unload those houses because they are unwinded, their shareholders, the share prices are already tanked, so they don't need to make a profit on that. They just need to get rid of the houses as quickly as possible at any single price. They just need to dump those houses. And even in that scenario, Opendoor Technology is still saying that they're going to be close to break even. So even though their competitor is saying, okay, there's no way we're going to be profitable ever.
What makes the difference between one and the other? What's the difference?
This is what management say. Management says, so, whenever I put that, it's like management says, because management says, it's like you build a narrative respective to your results. If your results are good, it's like we have all the insights. And if the results are bad, it was someone else's fault. Mm-hmm. So management says at this point in time that our financial models are strong, and we've got 7 years of backtesting data that we continuously backtest to do over the cycle of the houses prices, and our model is superior. That's why we're able to kind of be approximately EBITDA break even. So they are saying, okay, our purpose right now, which makes a lot of sense if you think of it. They say our purpose right now is to grow market share. We're going from approximately 24 markets in Q3 into 44 markets in the United States, and we're just going to go and take as much market share as possible. So they're not trying to make as much profit right now as possible. But even though, obviously shareholders are really anxious, can they make a profit? And they're growing really, really fast. They're just at break even still. It's very, very strong business model.
Are there any scale advantages?
Well, the idea is the more data you have, the more you can cross-check to different markets. So they would say, yes, that there is a scale advantage because you're getting a lot of the problem when a person comes to sell the house is that they didn't really trust whether they were selling it online to a website, whether that money would actually show up. So Open Door or Zillow, it doesn't matter, both companies were making the offer to the seller, and the seller didn't want to go through with it because they didn't trust that the money would actually show up. There was a lack of trust. But as more and more consumers become familiar with that brand, it builds trust, and they're able to get very, very close to the market so that they don't have to underprice themselves too much. So there is a lot of scale advantage. Yes, I would say that the more that it scales, because it's a very leveraged business model, right? They need to to buy those houses, you have to get a lot of debt on the balance sheet. So the balance sheet
you've mentioned a point that who cares about EBITDA when they have a lot of debt? So
the EBITDA is earnings before interest depreciation and amortization.
You're taking the interest, one big part of the business out. You're not accounting for it.
So if you look at the enterprise value of Open Door Technologies, it's 20 billion. So if you add, so the market cap is approximately 12 billion or something like that. So if you add the debt on top of that, that's enterprise value, right? Market cap plus debt is your enterprise value. So you would look at enterprise value to EBITDA, or you would look to market cap to earnings. So if you strip out the debt, you'd look to earnings. In this case, I believe that they're going to make approximately 690 million of contribution profit. So contribution profit is it's kind of an adjusted figure, but it's quite towards the bottom. It's normalized. It doesn't kind of account for small things that may happen, but it's a very close approximation of a gap. So if you look at market cap, you should look at earnings. But if you look at enterprise value, you look at EBITDA.
But I know, and I understand all the difference, accounting difference, but in a business where you'll always have that, right? Or you can make it all equity, but you'll always have that. And the interests are a big chunk of your costs. I'm not sure if EBITDA it's the best.
So their interest is approximately for the year growing into next year is 200 million. So they're making approximately 10 billion in revenues, and their interest is 200 million. It's not a lot. It's in the grand scheme of things, this is not like the big deal. 200 million when you're making 10 billion in revenues. It's a decimal point there. But I think it's quite interesting. So anytime I believe that your main competitor can't continue this game, it's showing that the business that is able to continue has a strong competitive advantage, because there's no reason for them to survive and to be marginally profitable. So as I said before, they like any business is rapidly growing, you don't want to be maximizing profitability. You have to get as far down this path as fast as possible. So they already said that they've pulled forward, just this is important, they've pulled forward their financial model by 2 years. So initially, it was at the end of 2023 that they would be making 10 billion in revenues. But they've grown so much faster than they expected that right now is already at 10 billion. So they're just growing really, really fast, and they're marginally profitable. Even if you strip out the debt, even if you strip out the the taxes, everything. Like it's like very, very small, but it is profitable. And it shows that you got a lot of wiggle room and flexibility. They don't need to keep growing at such a fast rate. They can slow down a little bit if they wanted to. But obviously, that's not their point, right? Their point is to take as much market share as possible.
Okay, we reached the end of our episode.
Yeah.
It's a great one. See you next week, Michael.
Yeah. Thank you so much for having me. Thank you.